There's been a lot of gloom and doom headlines about what's going on in the private credit space. I want to first talk about this idea of contagion, or rather maybe the flip side of that. Is this a widespread issue, or are we talking about really idiosyncratic, single issue concerns that can be mitigated on their own without broader market risk?
Well, the Blackstone $10 billion capital raise for opportunistic credit is exactly the right move. Mm-hmm. Brilliant job, Blackstone, and you know, at Marathon, we're very, very active in opportunistic credit for the same exact reasons because of what you just mentioned. The problems that we're seeing in direct lending leads to the opportunity. It is the flip side. That's exactly the right terminology, exactly what I would say. It's the flip side of what you'll see in opportunistic credit, because opportunistic credit is all about dislocation, it's about distress, and it's about capital solutions that'll be so much needed given all the problems that we see in direct lending.
So is the opportunity in taking the existing issues where maybe those values have fallen and capitalizing on that? Is it new lending where maybe those borrowers would not be able to go through some of the channels they would have been able to go through a couple of years ago?
It's all the above. And so what you'll see is you might not see capital solutions initially in the software sector, and that's where you have your biggest problems in direct lending, because if it's a bad software loan, it's a bad software loan, and the companies have way too much leverage. And so based upon 8, 9, 10 turns of leverage that direct lending lent to finance the software companies, it's going to be extend and pretend initially, followed by distressed or defaults, followed by massive losses flowing through in the software sector when you talk about direct lending. So we have to take that, you know, that pig through the python, and it's going to be a pig these next many years for the software sector.
Where are we in that python? I don't know what the segments of a python are, but where are we in that python? Is that imminent?
Early days. And the reason why it's early days, because the valuations just got reset in the last quarter, just got reset, and the maturities aren't happening until 27 and 28, and the price to get out is a very, very low price. The price to get out of these loans is not par. You can market to model all you want, but to transact in these loans, some of them are going to get transacted in the 70s, some in the 60s, some in the 50s, and some in the 40s. So the BDCs are telling you what you need to know about this when the BDCs are trading at 25 or 30-point discounts to NAV, and is trading there because of all the exposure there is to software. So the opportunities that you see in opportunistic credit is about capital solutions for other companies across a broad economy, across all the sectors. It's about dislocation, and it's about distressed. So there's opportunities across them. And direct lending, by the way, I think the next vintage is going to be a really good vintage because spreads are 75 basis points wider now, and so you get paid a better return for taking that risk. You'll be able to lend with better covenants and stronger documentation with less leverage. And so why make lenders shouldn't be lending at all more than 5 or 6 turns of leverage, and yet the software companies, somehow, some way, the lenders were way off the ranch and were lending at 8, 9, and 10 times of leverage because they could justify it based upon ARR, and we now know that those models are
ARR.
That's a big word for you tonight, Romeo.
I know. We've been talking about ARR all day. Do you believe in ARRs?
I don't believe it. You should be lending based upon ARR.
Based on ARRs,
And so the valuations of 20 times that PE paid for a lot of those software companies allowed the private credit managers to justify somehow, some way they can lend 10 times on that business, and it's way too much leverage, and the companies can't sustain that level of leverage, especially as valuations have gotten cut in half.
Well, Bruce, I do want to go back to the python because I think that really is really illustrative. So, so the pig is still closer to the mouth of the python. The python just ate the pig. Do you just stay away from software? I mean, you talk about the opportunities out there. It sounds like a broader set of opportunities, but in the meantime, I mean, do you just keep your...
Katie, the reason why you have to stay away, the default rate is going to go to, mark my words, 15%. It's
in
not
software?
In software specifically, for DL managers, 15%. And it won't be 15% one year. It'll be double-digit default rates for 3 straight years, I believe. And so it's going to be massive, number one. Number two,
but there are some firms that get taken out for that. There are some firms that are so heavy in software.
Heavy in software. Yeah. And so the second part of that is, okay, there's a default, and the defaults are going to be massive. But what's recovery rates? I believe the recovery rates will be 0 to 30 cents on the dollar on your average software default, averaging 15 to 20 cent recovery, not 70 to 80 cent recoveries. So losses will be massive when the defaults come in. So you can be early in being a capital solution for that company, or being the firm that rolls the existing debt, and that'll be a mistake. And so I know that there's very little money available to make the new software loan.
Right.
If you made the new software loan, you'd only lend at about 3 to 4 times leverage and a much, much wider spread. I'm talking about several hundred basis points wider, and you may not still be paid well for the risk.
Right.
And so I believe for all the software loans that have been made in the direct lending business that were 8, 9, and 10 turns of leverage, there's no one that's going to refinance that anywhere close to the levels of financing that was provided previously. Wow. And that is the problem. And so when you have a correction like this in direct lending, where there's been outflow of capital, when the pricing has been reset, it's going to make direct lending a much better risk reward on a go-forward basis, and it's going to lead to a dearth of capital, which is why opportunistic credit for all the other industry sectors will be so appealing.
So I also do want to talk a little bit more about the end investor, because, you know, we opened up the segment talking about Blackstone raising those $10 billion, specifically looking at appetite from institutional investors. And we heard something similar from Goldman, of course. They got a redemption request of 4.999% for their private credit fund, but they said that their reliance on institutional investors really helped them stay below that 5% cap. And I do wonder, you know, how you see the retail investor in private credit evolving, because, you know, you think about a lot of those investors who aren't being able to redeem their money. A lot of them are individuals.
Yeah. So I think the interval funds and these annual funds that, you know, that pay annual incentive fees that retail invest in, 5% quarterly gates, 20% per annum. It's not a bug, it's actually the feature, and it's actually perfect. And the reason why it's perfect is because direct lending, if you have a solid portfolio, generates 10% annual cash flow. And if you ladder your maturities, 5-year loans, 20% coming due a year, you have 20% principal coming back at you a year, plus your 10% cash flow. That's 30% a year coming back. You can make those 20% redemption requirements. And so the fact that more want to redeem is not the issue. It was set up a maximum of 5% per quarter. And so I think the fund structures are actually perfect. The problem is the underlying portfolios may not be perfect if they invested too heavily in one sector. And so if you put 20%, 26% of the capital into software, you leveraged it one turn, then 52% of the investor capital is actually in the fund software that's at risk. And so the problem is the underlying portfolio and losses. That's why there's a run, as opposed to the structure itself. The structure is perfect, I believe.
And there's been a lot of talk about that. Also, the idea of maybe some promises that were maybe a little bit overpromised, not necessarily from the funds, but certainly from some of the advisors. I do want to get your thoughts, though, on this idea that, I mean, you obviously have some concerns about the software space, but there's been this idea that we're seeing a lot more direct lending, much more focus on, you know, we call it, was it the HALO is the acronym everybody's using, the idea of some of these companies that in theory would be a little bit more immune to what we're seeing in the software space, the AI space, technology space, et cetera.
Well, there's a big reindustrialization in America here. A lot of CapEx, a lot of industry and manufacturing coming back, and there's a big need of capital that firms like Marathon that are providing. HALO, hard assets, low obsolescence, the first thing I think about.
And wasn't that the core of what direct lending sort of always was?
Well, I think it's the core of asset-based lending.
Asset-based lending.
And so asset-based lending, lending against plant, lending against equipment, whether it's infrastructure assets or, you know, cranes or bulldozers or aircraft or turbines or transformers. When you lend against heavy assets, that's what I refer to as halo. There are also some companies.
There's no ARR in there. You got to.
There's no ARR in there. You're lending at an LTV basis. You have the hard collateral as your protection, and that's the first form of halo. So we love at Marathon asset-based lending. Asset-based lending has been a great opportunity, that strategy, in terms of the returns, in terms of the consistency, in terms of protecting principal, because you have the hard assets as collateral. Companies that manufacture those hard assets are also doing quite well for the same reasons in this current environment. And so I much prefer things that are hardware than things that are software in this market environment, based upon everything that we know. A, the valuations are much more appropriate, and B, the ability to make sure as a lender you're always getting your principal back is much better insured.